we had the thrill of victory. The rates were cut. And as I warned, be careful, because it doesn't assure the 10-year Treasury yields coming down. That's the reason for cutting the Fed rate, to bring down the 10-year Treasury. The Fed does not control the 10-year Treasury yield. And that's the important one, because that's the one that identifies what your interest is going to be on your mortgage, your cars, your trucks, your business loans, your school loans, your credit cards, all that. I said, if you remember, they can do this deal, and they can cut the Fed rate, but the 10-year Treasury yield is not going to come down. Trump needs it to come down because he's paying the national debt and the deficits with T-bills. He's borrowing money 1 month, 2 months. You can't borrow 1 month, 2 months, 12 months. You can't. That's inflationary, number one. You start paying with T-bills, you really hurt the economy. You need to have the investors, Japan, China, and the UK, lend us money over, 10 years, 15, 20, 30 years. But they're not lending us money because they're buying gold, because look at where gold's going. So he made the statement that he was going to do this rate cut, and it should bring the 10-year Treasury yield down. And I said, yeah, it will maybe for the first day, but wait till the second day. It usually goes the other way, and it did. It has. Now, what does this all mean? Well, because he turned around, he immediately said this, that he was going to go back to QE, but he didn't call it QE.
As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months.
Oh, yeah. They said that in 2008, do you remember? In 2008, he said the same exact thing. It wasn't him, but it was Bernanke and it was Obama. They said, we're only going to do this for about 2 months, 3 months. We're going to print, and this is why this is scary, because we're going to print $80 billion a month, they said back then, and we're going to buy 10-year treasuries to try to get the yields down to stimulate the economy after our big crash we had in 2008, to try to get mortgage rates down, car rates down, automobile rates down, everything down, and school loans down. We're going to do that. Now, don't worry, it's going to help everybody. Well, no, of course not. That policy doesn't help anybody but the wealthy, because stocks go through the roof and everybody else gets hit. So what happened was, when he said that on Wednesday, that told me right there, he knew that his quarter-point rate, he knew was going to fail like it did a year ago. He knew the 50 basis point rate cut a year ago wasn't enough to stimulate the economy. Why the hell would 25 basis points now stimulate the economy? It wouldn't. He also knows that the U.S. deficits are increasing. Last year, they were increasing. The reason why the 10-year Treasury yield wasn't allowed to go up, because the bond market's saying, no, look, we got to let the 10-year Treasury go up, because we don't get the 10-year Treasury yield to rise. Who the hell's going to buy our bonds? We need our three major banks to buy our bonds. Or otherwise, we're going to have to pay our national debt and our deficits. We're going to have to borrow money short term, 1 month, 2 months, 3 months. And that's crazy, because that creates inflation and a host of other problems. Well, that's exactly where we are today. Now, I also said that day on Wednesday, or before Wednesday, a week ago before Wednesday, I said, you're going to see the rates come down a little bit, and then within 1 day, you're going to see the yields go the opposite way back up. That's what's going on. So let's talk about doing this $40 billion again, repeating this $40 billion again. Buying treasuries is insane. Let's look at history. In 2008, they were buying $80 billion in treasuries. Printing money, that's very inflationary. So inflationary, let's think about it. You got to increase the money supply. You got to increase the money supply to get the money to buy the treasury. So when you increase the money supplies, the first thing they did, they dropped rates from 5% down to 0.38%. That's the first thing they did. The Fed rate, that's the Fed rate. Okay, they tried to get that Fed rate down, hoping that they could bring that, the 10-year treasury would follow. It didn't. So what they did was from 2008 to 2022, by keep on increasing the money supply by 166%. Here, look, take a look at this chart. 166% they increased the money supply by. Why? Because they did 4 QEs. 4 QEs. All QE does is increase inflation. All QE does is make the rich richer. The inflation kills Main Street. So think about what happened. Now he says he's going to start again, and people celebrated, and the market went up almost, 500-600 points on Wednesday? What are you, nuts? So increase in money supply, you can see it right here. He did 4 QEs. That's the result of increased money supply, to do 4 QEs, to go in and buy treasuries. But the problem is when you have inflation going up from 2008 to 2022 by 166%, the money supply rather, then you use $300 billion, okay, to purchase treasuries, the 10-year treasury. That's what they did. They increased the money supply. They go in and they bought $300 billion in treasuries, and we had 4 rounds of QE. When we're finished with the 4 rounds of QE from 2008 to 2022, inflation increased. Remember, from 2008, inflation was 2.8%. 2022, at the end of the last QE, we were up to 36%, meaning whatever you bought in 2008, you have to now pay for that same item 36% more. So that's what's going on. So everybody got so excited, the market went up, I think it was 600 points on Wednesday, right? He's going to cut rates, everything's going to be wonderful. No, here's the proof back here. It's not wonderful, because we're going to turn around and inflation is going to go right back up. But who gets wealthy? The very wealthy, the top 10% the stock market, they control 93% of the stock gains. So the stock market's going to rally again. Here, look what happened back here. In 2008, when they started QE, look how the market collapsed, and look how they got to rally. It's all artificial. There's QE1, QE2. They didn't want to call it QE3. They changed the name to Twist. Look at that. Look how the market rallied. And then the market continued to rally because we kept doing the same thing over and over. Now there's a problem. Not only do we have the problem with QE, we also have the banking problems. Now, the bank problems, everyone says, oh, don't worry about it. That doesn't matter because it's not really a loss. It's just like a fake loss. No, it's not a fake loss. It's a real loss. Now, it means that right now, as long as they can keep their cash flow up, the banks, yes, there's no problem with it. They can hold it on the books. But the problem becomes everybody right now is having problems. The car payments are behind. Everything's behind. There's foreclosures going on, and that will take the cash flow in the banks and start dropping. And when that starts dropping, the Federal Reserve, remember, you got to maintain a certain amount of money for emergencies. When that starts going down, guess what happens? Those undisclosed losses are then disclosed, and that's when you have trouble, the same way that we had with the 4 banks in March of 2023. Remember? We had those 4 banks they got hit hard. Same exact thing is going on right now. I mean, but I guess people just don't remember this. So we got to really be careful here, all right? So in the meantime, let's stick with the stocks that are working for now. And those, of course, are discretionary stocks, are gold stocks, and bank stocks until they don't work anymore. And when they don't work anymore, they'll probably try to go back one more time to the tech stocks. That won't work. And then finally, we start shorting if the market starts correcting. So they threw a real curveball at us, remember, on Wednesday when he announced that he is going to start another QE of $40 billion a month. But he never said QE. Watch in the next few weeks. They're going to come back with a different name. It's not going to be QE. It's going to be a different name, but the circumstances are going to be the same, and the results are going to be exactly the same. You're going to have inflation go from 2.8% up by 35%. That's what happened with QE already from 2008 to 2022. Why would it be any different? So they're caught. They're caught. But it doesn't matter to you and me because we know how to go long and we know how to go short. It only matters to people that only know how to buy stocks. They're screwed. You've got to know how to sell short, and we'll help you with that. philsgang.com.